the risk of a contingent uncertain loss. An insurer or insurance carrier is a company selling the insurance. The insured or policyholder is the person or entity buying the insurance policy. The amount of money to be charged for a certain amount of insurance coverage is called the premium. Risk management, the practice of appraising and controlling risk, has evolved as a discrete field of study and practice. The transaction involves the insured assuming a guaranteed and known relatively small loss in the form of payment to the insurer in exchange for the insurer's promise to compensate the insured in the case of a financial personal loss. The insured receives a contract called the insurance policy, which details the conditions and circumstances under which the insured will be financially compensated.
Okay, now I will explain about a legal insurance. There are 7 types of a legal insurance. When a company insures an individual entity, there are basic legal requirements. First, indemnity. The insurance company indemnifies the insured in the case of certain losses only up to the insured interest. Second, insurable interest. The insured typically must directly suffer from the loss. Insurable interest must exist whether property insurance or insurance on a person is involved. The concept requires that the insured have a stake in the loss or damage to the life of property insured. What that stake is will be determined by the kind of insurance involved and the nature of the property ownership or relationship between the persons. The requirement of an insurable interest is what distinguishes insurance from gambling. Next is utmost good faith. The insurer and the insurer are bound by a good faith bond by honesty and fairness. Material fact must be disclosed. Next is contribution. Insurer which have a similar obligation to the insured contribute in the indemnification according to some method. Next is subrogation. The insurance company acquire legal right to pursue recoveries on behalf of the insured. For example, the insurer may sue those liable for the insured loss. Next is cost proxima or proximate cost. The cost of loss must be covered under the insuring agreement of the policy, and the dominant cost must be not excluded. Lastly is mitigation. In case of any loss or casualty, the asset owner must attempt to keep loss to a minimum as if the asset was not insured. Okay.
Friend, I would like to discuss about indemnification. Okay. To indemnity mean to make worse again or to be restored to the position that one was in to the extent possible prior to the happening of a specific event or peril. Okay. Accordingly, life insurance is a general not according to be indemnity. Okay. Insurance, but rather contingent insurance. Okay. There are the general 3 types of insurance contract that see to indemnity insurance. A reimbursement policy, and second a pay on behalf of policy, and the third an indemnification policy from insurer start point. The result is actually the same. The insurer pay the loss and claim expenses. If the insurer of the insurer has a reimbursement policy, that insurer can be required to pay for a loss and then reimbursed by the insurer carrier for the loss and out of pocket costs including with the permission of the insurer claim expenses. Under a pay on behalf policy, the insurance carrier would defend and pay a claim on behalf of the insurer would who would not be out of pocket for anything. Modern liability insurance is written on the basis of pay on behalf language which enable the insurance carrier to manage and control the claim. Okay, under an indemnification policy, the insurance carrier can generally another reimburse or pay on behalf of whichever is more beneficially to it and the insurer in the claim handling process.
Insurance. Life insurance provide a monetary benefit to a decedent, family or other designated beneficiary and may specifically provide for income to an insured person's family, burial, funeral and other final expenses. Life insurance policies often allow the option of having the proceeds paid to the beneficiary either in a lump sum, cash payment or an annuity. In most states, a person cannot purchase a policy on other person without their knowledge. An annuity provide a stream of payment and are generally specified as insurance because they are insured by insurance companies, are regulated as insurance, and require the same kinds of actuarial and investment management expertise that life insurance require. Annuities and pensions that pay a benefit for life are sometimes regarded as insurance against the possibility that a retiree will outlive his or her financial resources. In that sense, they are the complement of life insurance and from an underwriting perspective are the mirror image of life insurance. Certain life insurance contract accumulate cash value which may be taken by insured if the policy is rounded or which may be borrowed against. Some policies such as annuity and endowment policies are financial instruments to accumulate or liquidate wealth when it is needed. Okay, next, in many countries such as the US and the UK, the tax law provide that the interest of this cash value is not taxable under certain circumstances. This leads to widespread use of life insurance as a tax-efficient method of saving as well as protection in the event of early death. In the US, the tax of interest income on life insurance policies and annuities is generally different. However, in some cases, the benefit derived from tax deferral may be offset by a low return. This depends upon the insuring company, the type of policy, and other variables like mortality, market return, etc. Moreover, other income tax saving vehicle may be better alternative for value accumulation. Okay, thank you.
Hi, now I will explain about casualty insurance. Casualty insurance includes against accident not necessarily tied to any specific property. Is it a broad spectrum of insurance that a number of the other type of work compensation and some liability insurance? They have two casualty insurance. This crime insurance is a form of casualty insurance that covers the policyholder against losses arising from the criminal act and third parties. For example, a company can obtain crime insurance to cover loss arising from the theft of embezzlement. The second is political risk insurance. It's a form of casualty insurance that can be taken out by business with operation in country in which there is risk that revolution of other political conditions could result in all losses. That's all for me.
Hello, today I will explain you about the importance of insurance. Life is unpredictable and you cannot predict your own destiny with certainty. Hence, you cannot prevent the occurrence of premature death permanent and total disability, or critical illness. But don't worry, you can minimize the financial hardship on your family should something untoward happen to you. Life insurance is a financial vehicle that transfers your personal risk to an insurance company for a fee called the insurance premium. The traditional type of life insurance policies that you can purchase are term policy, whole life policy, and endowment policy. The latest innovation is the investment-linked insurance policy, which combines insurance protection with an investment plan. When choosing an insurance plan, it is important to understand that your insurance needs depend on factors such as age, marital status, number of children, employment status of your spouse, and so on. In addition, your insurance needs also change over time as you age. Hence, it is necessary to match your insurance policy to your insurance needs. That's all from me.